All right, welcome to my explainer video about trade deficits and exchange rates and their interplay. So the meaning of the balance of payments accounts, what is that all about? We'll go through some terminology and some sort of intuition there. And then what is the role of the foreign exchange market and the exchange rate when there is a change to international investment patterns? And the big hairy question is, when countries change something that affects their relative investment flow, what effect does this have on the rest of the economy? Let's get started. So here's a quick thought question. Why did the Swiss franc gain 50% of its value in 2009? And why did it hurt the Swiss economy, especially the exporters, and what could they do about it? To get to understand that question and offer some answers, we need to understand the capital flows and what's called the balance of payments. So here's a definition of the country's balance of payments account. And basically, all the money that flows between countries is accounted for in the balance of payments. So you can think about it like a family farm, cash inflow and outflow, right? So the Costa family, maybe they have an artichoke farm up in Watsonville area, and they're selling artichokes and they gain $100,000 in revenue. And they've got costs, of course. So let's say there's $70,000 of operating costs, $40,000 of food utilities replacing their car, $500 of interest on the bank account, $10,000 interest on their mortgage, and the $25,000 loan to help pay for farm improvements, which they haven't used all of. How do we account for this sort of conglomeration of money inflows and outflows? Because the same can be said for a country, right? A country imports, generates revenue, it's got costs, it's got trade between it and other countries, not just for the buying and selling of goods and services, but for the paying of interest. So one way to summarize the Costas financial flows are this way. So they've got sources of cash, uses of cash, and net. We think about it in terms of purchasing goods and services. This would be akin to imports and exports, right? We've got interest payments, right, between this family and other businesses or families, and a country has the same thing. And there's loans and deposits, right, which is another form of investment. So in 2013, if you want to think about the U.S. in the same way, we've got payments from the sale of goods and services on line number 1 here. And you can see we've received payments from foreigners to the tune of $1,800, $1,838. And payments to foreigners, what do these come from? These come from, of course, imports and exports. Payments from foreigners are for our exports. Payments to foreigners are for our imports. And then we've got line 2, which is factor income. This is payments for the use of factors of production owned by residents of other countries, mostly investment income on overseas loans, profits on foreign-owned companies, etc. And then we've got transfers, and transfers are sort of wires of money back and forth between countries for which there is no obvious payment for a good or service. So this would be, for instance, families from Central America that work in the U.S. might send part of their money back to support families at home. And then there's transactions that involve governments selling assets to each other, like foreign exchange reserves. This is not a huge deal, and it's nuanced. You can look up more details on that online if you like. And then transactions that involve private sale and purchases of assets like stocks or companies. This is what we would call investment between countries. So an interesting thing to notice here is that our particular country has a pretty large negative in the current account, right after line 3, and a pretty large positive in the financial account after line 5. And that's no accident. Countries that tend to be net importers like the U.S., so we run a pretty big trade deficit. We import more than we export most years. We will find that we import investment funds from abroad most years as well. So it's often said that a deficit in the current account is always balanced by a surplus in the financial account. And for countries that work the other way, for instance China, it will find that it's got so much flush cash from all of its exports, and it's running a trade surplus, that it will have cash to send abroad. So it is a net lender or a net sender of money in the financial account. So its financial account will be negative, almost as large or around as large as its current account surplus. So countries tend to balance out that way. And that's probably the key finding of all of this. How do we sort of make sense of all the terms here? Well, the balance of payments on the current account, which is also called just the current account, is that balance of payments on goods and services plus net international transfer payments and factor income. So it's the trade, the payments that go to for trades of goods and services, and then the balance of payments on goods and services alone is just the goods and services without the transfer payments and factor income. The merchandise trade balance goes even more specific, and it's just imports minus, or exports minus imports. And finally, the balance of payments on financial account, or the financial account, is the bottom lines. That's the difference of investment flows, basically. So here's a visual way to think about it, if it's taking a while for your brain to wrap around this. The current account must equal the financial account because net inflows of cash must equal the net outflows. In other words, if the U.S. is going to pay for all of the imports that we're doing, that cash needs to come from somewhere, right? So this isn't necessarily the easiest thing to understand, but if you can, sometimes what I'd like to do is think of the U.S., let's say the world only has two countries, the U.S. and this country called rest of the world. And so the U.S. runs a trade deficit with the rest of the world, let's say. And so a bunch of money is coming from the U.S. to pay for the imports that we're getting from the rest of the world. In fact, much more so than the money coming back to pay for the exports of our goods to the rest of the world. So you can think of the rest of the world as sitting on a growing pile of cash. Every year the U.S. runs a trade deficit. And so what happens is the rest of the world has a whole bunch of cash, and as good, rationally self-interested humans will do, we look around for good investments. And if there's a pile of cash sitting around waiting to be invested in the rest of the world, and it's starting to find its homes there probably is going to be sort of still a surplus of cash, because there's just every year there's cash building up, and there's not enough investment opportunities necessarily to absorb all that cash. So that cash might go to and will come back to the U.S. So when I think about the payments for assets on the outside flow and the payments for goods on the inside. So where does the U.S. stand? We lead the world in our current account deficit in absolute terms. So who's running all the surpluses? Clearly somebody's exporting more than they are importing. It's not the U.S. So here are your big current account surplus runners. All right, so let's imagine a hypothetical change in investment and how that would flow through the exchange rate and back through the trade in goods and services, keeping everything sort of balanced in the balance of payments. So let's imagine, first of all, that the demand for dollars looks like this. The European purchases of U.S. dollars amount to $2 trillion. One is for purchase of our goods and services. That's our exports to them, their imports from us. And then another $1 trillion to buy our assets, so investment in the U.S. The U.S. does remain one of the largest, if not the largest, destination for foreign direct investment in the world. So the U.S. also buys from Europe. We buy, let's say, $1.5 trillion of European goods and services, so we demand euros to buy that stuff, and to trade for euros, we have to supply dollars. So this, the sale or supply of dollars on the foreign exchange market will be 1.5 for goods and services, and then we also are investing in Europe, so let's say $500 billion for that. So we started out in balance here with the U.S. Sales of U.S. dollars on the foreign exchange market at 2. All right, and on the balance of payments, you can see we've got a balance of payments on a current account of negative 0.5. We're in a trade deficit, and we're exporting more dollars to buy goods and services than we're importing. And then over here, what's happening is cash is piling up in Europe, and some of it's coming back. More is coming back to invest in the U.S. than the U.S. has available to invest in Europe. So there's a net inflow of financial investment dollars coming from Europe to the U.S. That's the +5. All right. So here's our supply and demand for U.S. dollars on the foreign exchange market. And how we would model that is, let's say there is a change, some reason for an increase in the demand for U.S. dollars, and let's say that for whatever reason there's maybe a slowdown in investment opportunities in Europe, and so a bunch of investment dollars leave Europe and come to the U.S. And so the demand for dollars has increased. The dollar has appreciated, and here's what that looks like here. So because the U.S. dollar has appreciated, U.S. goods are now more expensive, so foreigners will buy fewer. Let's say the Europeans buy 0.25 trillion less of our goods and services, so demand for dollars drops. But U.S. assets are up, so this was the whole driver, right? U.S. investments are now more attractive, and so we see an increase. It started out as 1, and it decreased by 0.25 to 0.75, but then we've also have an increase of 0.5 up here to buy the U.S. assets, making for a net gain of 1.25, leading to a total demand for dollars from both goods and investment of 2.25. So total purchases of U.S. dollars, demand for dollars is up 2.25 trillion. What about U.S. sales? So remember, the dollar has appreciated. We can afford to buy more European goods. So we do. We increase our imports by 0.25 and no change in European assets. So total sales of U.S. dollars is 2.25. And what that looks like here on net is the U.S. balance of payments on the current account. The change in the trade flows for goods and services is down by 1.0 to reflect the fact that we're now importing more and exporting less by $1 trillion. But to balance it out, on the financial account, we are importing more financial dollars. So there's a net inflow. There's a sort of on the current account, we're sending more cash abroad than we used to net, but on the financial account, we're bringing more payments in from abroad. So this is how a country can and does continue these current account deficits or these trade deficits that the U.S. has. Isn't global economics amazing? Any change in the U.S. balance of payments on financial account generates an equal and opposite reaction in the balance of payments on current account. This almost sounds like a law of physics.